Hello, hello. Good. Got power?
Good evening, ladies and gentlemen. Thank you for attending the CCISD Annual Retirement Workshop. We're really thankful to see you here all tonight, and hope you got to sign in on your way in and then pick up a few goodies on the table. My name is Christy Warnke. I'm your Associate Director of Employee Benefits and Risk Management. This is a purely informational and voluntary workshop for you to get more information from our two guest speakers here today. On the screen, you see Jim Freeman and Clay Campbell. They're with Elite Plus Financial. They're going to go through the presentation, hopefully answer some of your questions that perhaps you've already come here with. But in the event questions come to you, we're going to be the last ones out the door, so you're welcome to meet with us one-on-one afterwards. And then, of course, further questions, you're welcome to meet with Elite outside of the workplace. I just wanted to, again, say thank you. This is being live streamed on the CCISD YouTube channel, so you're welcome to watch it in the future with your spouse or re-watch it and perhaps pick up different information that you didn't retrieve tonight. And please do me a favor, when you go back to your campus, to your classroom, to your department tomorrow, be my walking billboard for workshops and meetings like this. We have over 5,000 plus employees. We just want to get the information out. So you all have the information that you need to make good decisions for yourself and your family. Whether you are planning to retire this year or 5 years from now, this is still valuable and beneficial information for you and your family. So again, thank you. I'm going to turn it over. The presentation will be co-spoken with Elite Plus and then Deborah Bodetta, which you may recognize, benefits coordinator out of my office. So I'm going to turn it over to Deborah. Thank you, and have a safe travel home tonight.
So I'm so glad that you guys are here. And for those that are watching live, if you have questions, you can always send those questions to insurance@ccisd.us. And you can also call the office at 361-695-7210. We know that you don't have the ability to be here and present and ask those questions, but any question that you may have, feel free to always contact the office or email us at any given point in time. So that is insurance@ccisd.us. And that's 695-7210. I will be sharing some additional information at the end of the presentation, so we will go ahead and pass this on over to Clay.
Good evening. How's everybody doing? My name's Clay Campbell. This is Jim Freeman. We're with Elite Plus. You may recognize it from campus to campus doing our meetings. We're here to talk to you guys about TRS, just kind of like we do at the campus level. A little bit more in depth this time. We're very, very informal. You guys know us. If you have questions while I'm talking or Jim's talking, please feel free, raise your hand, throw something at us. We're more than happy to answer questions. That's how you learn a lot of this stuff, is just by asking questions while we're going through it. So don't let it pass you without asking the question and everything. And like I said, we'll stick around afterwards also. If you have questions, you want to meet more personally, we'll be glad to meet with you after this is all over with. Jim will interject while I'm talking. I may interject while he's talking. Like I said, we're very informal, so we'll just get going. There is a card out there at the front. If you did have questions you want to meet personally in our office, go over things in more detail. We're glad to do that to you. Just put your name and contact information on there, and we'll touch base with you and set up an appointment, and we can meet in our office as well. So here's two important pieces of information if you're getting ready to retire. This is where it all happens, right? You go to your website, log into your portal, which, by the way, if you haven't recently in the last 6 months to 9 months logged into your TRS account, it looks like they have updated their website You probably need to go in there and create a new username and password. Looks like they're requiring everybody to do that. But log in there, check all of your information, personal information, addresses, especially your years of service and your salaries that were reported to TRS. Make sure those are accurate, because you want to do that before you file your paperwork, right? Or you can call TRS and request a packet as well. Sometimes you get on hold for 30, 40 minutes. Sometimes early in the morning is the best time to call. So when can you retire? Everybody, I'm sure here, knows that magic number, right? Your age and your years of service equals 80, correct? So that's what we're going to do, the rule of 80. That's when you're eligible to retire from TRS with full benefits. Or you'd be at least 65 years with 5 years of service. You're also eligible as well. And in determining your years of service to be eligible, you can also count time if you taught in a public school out of state somewhere. You can use those years. There's ways you have to do this. You have to purchase these years. If you had active duty military service, that by far is something that you absolutely need to look into if you did have active duty military service. Things like that. If you worked for another state entity like ERS, TMRS, those have proportionate retirement, so you can use those as well. So if you have questions over there, if you did participate in one of those, come meet with us and we'll show you how that works. Like I said, for these types of service, you have to use, there's a TRS calculation you use that you purchase those years to add to your years of service on there, but sometimes it's well worth it. So how much will your TRS pension pay? The formula is the same. It hasn't changed in quite a while. They're going to take your average salary, and if you're grandfathered, they're going to take your highest 3 salaries. If you're not grandfathered, they're going to take your highest 5 salaries. And the way you determine that, you should have got a TRS statement in October. If it's got 3 salaries on it, you're tier 1. If it's got 5 on it, you're tier 2 through 6 on there. So that's the very easiest way to do so. But they're going to take your years of service times that 2.3% factor times your salary average to figure out what your pension's going to be. So for example, if you went 30 years, they're going to take 69% of your salary average. 32 years, 73.6, and so on. So that's how they're going to determine how much your pension is going to be based on your salary average. There's our example. Her name's Hattie Nuff. She's got $63,000 salary and 32 years of experience. Excuse me. So her average up there you can see is $62,000. They're going to put that into the formula, 32 years times 2.3% times the 62,000. So there's your 32 years. She's going to be making $45,632. And she's used to making 62, correct? See, there's that income drop that we always talk about every year you got to be prepared for. And we'll show examples of that here. But after 32 years, she's making $45,000 a year based on the TRS formula. Everybody kind of understand where they get that from? But working versus being retired when it comes to as far as net take-home pay on here. So this is your school paycheck. So Hattie was making 63. So that's about $52.50 monthly gross before all the deductions. You take out income taxes and your TRS contribution and your health insurance. She's taking home about $4,300 a month before when all things are said and done. There's a few deductions that are missing. We'll go over those in just a minute. Now she's retired on Monday, and her gross is going to be about $3,800 a month. And the only thing that comes out of your retirement check is your health insurance if you choose it, and taxes, of course. So her take-home pay is going to be about $3,300 a month. So there's about an $1,100 difference in take-home pay that she's got to realize on there. But like I said, there's other deductions that you've got coming out of your working paycheck. There's other expenses that you have to cover as well. There's about a $1,000 difference. Let's go back and look at the actual reductions. So let's say most of us have some sort of disability insurance, gas, clothing, miscellaneous, $200 a month. These days it's probably a little bit more than that. And then if you have a 457 or a 403B or some other supplemental retirement plan that you're contributing to, that won't come out of your check in retirement either. So her actual take-home pay may be about $3,600 a month, give or take. And then her retirement check's still going to be that because that's all the deductions that are going to come out of it. So now you're looking at $3,600 versus $3,300. So it's about a net difference of $338 once you take into consideration all of those deductions. Here's the big one, right? Everybody asks about this, and am I eligible for Social Security? The answer is yes. If you contributed to Social Security for 10 years or more as an individual, you are eligible for some sort of Social Security benefit on there. There's two different offsets when it comes to Social Security and a government pension like TRS. So the good news is your TRS is never affected. You don't have to worry about that as far as that. Social Security benefits are the ones that are affected. You are eligible if you paid into the system for at least 10 years as an individual. However, if you retire under TRS, you're going to fall under what's called the windfall elimination provision. That's for individual Social Security benefits. The Social Security amount you get to keep is based on how many years you contributed. So if you had 10 years, you're going to get basically the minimum of what your benefit says. We'll just kind of show you. So if you contributed anywhere from 0 to 9 years into Social Security and you retire, you're not eligible for anything. You just contributed to the cause for 9 years, basically. If you contributed anywhere from 10 to 20 years, you're going to get what they say on their sliding scale, about 40% of whatever your Social Security benefit is, up to the max reduction. If you contributed 21 years, they're going to add 5% to that. And then 25 years, they're going to add 5% for every year after that. If you contributed for 30 years into Social Security, you're going to get 100% of both. So your Social Security is not going to be affected if you have at least 30 years of contributions to Social Security. The maximum reduction this year is around $558 a month. So for example, if you did contribute to Social Security and your statement says you're going to get $1,000 a month from Social Security when you're eligible at that age, you could probably count on about half of that up to the max reduction up there. So the good news is if you did contribute for those years of what's called substantial contributions, you are going to receive something. It may be a couple $100, it may be $1,000, but something is better than nothing, correct? So Social Security from your spouse, this is where it kind of gets complicated. Years ago, there was loopholes everywhere. What year was it? 2003. If you're in education then, you might remember people quitting districts like CCISD, going to Fremont. My hometown in West Texas also did the same thing. What they would do is they would quit, go to that district like Fremont, pay Fremont a fee for being an employee for 1 day because Fremont contributed to both Social Security and TRS. So the loophole said as long as your last paycheck came from an entity that paid both TRS and Social Security, then you're eligible for 100% of your spousal Social Security benefit. They got wise on that, Social Security did. So now the loophole is your last 5 years of paychecks have to come from an entity that pays both Social Security and TRS to be eligible for that. So 60 months worth of paychecks at the end on there. So those are very few far between service centers, Austin ISD, San Antonio ISD, Houston ISD. The larger ones, they pay both and usually pay both. So we'll go with the calculations anyway. So the law is if you didn't work at all and you're married more than 10 years, you're eligible for half of your spouse's Social Security benefit while they're living. If your spouse passes away first, then you become eligible for the full Social Security benefit on it. But when you retire from a government pension, there's something else that we fall under. So for example, your spouse gets $2,000 a month from Social Security at age 66. You're eligible for $1,000 a month at age 66 also. However, if you retire into the TRS system, this is called the government pension offset when it comes to spousal Social Security. The Social Security is going to cut your spousal benefit by 2/3 of whatever your TRS check is. So, for example, here, you're supposed to receive $1,000 a month from Social Security as a spousal benefit. Your TRS pension is $3,000 a month. So they're going to take 2/3 of that, which is $2,000, subtract it from what you're eligible for, so there's a net of 0. So at least you don't have to write them a check, wait for that law to come into effect, right? So your benefit is nothing. Now, on the flip side of this, if it works out to say your spouse's Social Security is $3,000 and your TRS is $3,000, if your spouse passes away first, you're going to end up getting about $1,000 a month plus your $3,000 from TRS also. So there are ways that it does calculate out. A lot of the times, and more times than not, it doesn't calculate out very well on the spousal side. TRS Care, we talked about the only two things that come out of your retirement checks are your taxes and your health insurance if you choose it. TRS Care is a pretty good plan as far as health insurance goes for group plans for retiree insurance. These rates are based on 2018, 2019. They've changed a little bit. We're just going to kind of get an estimate on here. So if you choose the retiree insurance just for you, it's about $200 a month on there. It's an 80-20 plan. It's a $1,500 deductible. Once you meet that deductible, then it goes back, you just pay 20% after that. It's got prescription coverage, things like that. When you order your packet, there should be information in there in detail of how the plans work on that. So now with TRS, there's two choices. You've got an under 65, not Medicare eligible health insurance, and you've got an over 65 Medicare eligible insurance on there. So you've got to choose which one, depends on what age you are, and then you choose how to enroll in that. So you pay the full amount of your medical and prescription costs until you reach your deductible, $1,500 for an individual, $3,000 if you cover your dependents in the family. And you can see the cost of insurance goes up pretty dramatically if you start adding dependents on that. Once you meet the annual deductible, the plan pays 80% of medical and prescription. And when you reach your maximum out-of-pocket expense limit for the year, it'll pay 100% on there, which is $5,650 for your individual on there. Now we're going to kind of switch gears and go through the TRS packet. Jim's going to go through that. Again, if you have any questions, just holler out if you need to.
Thank you, Clay. All right, is our brain still on go right now? I know there was a lot of numbers, and the Social Security stuff can be really difficult. Doing this for almost 25 years now, and that's probably the most misunderstood provision that we see. Okay, because there's a lot of different details to it, but we can tell you specifically what you are or not going to get if you would like to. It doesn't. We do it for free for you. It doesn't cost you anything, but we can tell you so you can plan, you can budget accordingly based upon what you're going to get in retirement. Okay, because again, like I said, it could be confusing. So the TRS packet, for those of you that he talked about in the beginning, how to order it, you could go online and you could fill out the form, or you can call them and then they'll send you a packet. And I would do that pretty quick if you're thinking about retiring this year, because TRS, they always start getting busy around March or April for those May retirement dates. So that's their busiest time of year. So I would order it as soon as possible. In addition to that, you're going to have a ton of options in there. Okay, I always encourage you. I actually just got back from Austin at a learning conference. Just rolled in a couple hours ago, and we had a lot of good barbecue over the past couple days. So if you want to go to Austin and talk to TRS, I always recommend that you do that. They're really, really good. They're really, really helpful. However, they cannot legally give you financial advice. They're going to tell you what your options are, and here's what you can choose from. So we'll go over that, but you need to maybe sit down with as many people as you can to form opinions on which choices that you're going to make. Because once you choose these and you turn that packet in, when they end up sending you your first retirement check, it's extremely hard to go back and make any changes. Because you're picking beneficiaries, sometimes people pass away early or something like that, and then maybe we said, well, how come I didn't maybe review this more before I did decide to retire? So it's very important that you get as many opinions as you can, as much good advice as you possibly can too. But in this, you're going to see, I know this is a lot of information. You're going to see all this come in your packet. Okay, it's going to have your estimate of benefits in there. It's going to have your years of service. It's going to have your salary as they have it right now. So obviously, you're going to keep getting paid through the school district for the next few months if you decide to retire this summer. And then it'll be pretty close. It'll be within about $50 to $100. But then after that, it gets right to the penny. TRS will send you a letter showing you what you're going to get. But here are the options that you've got. Okay, so we'll go. You're going to see something like this. So what ends up happening here is you see the standard annuity and option 1 through 5. So you're going to have 6 options. Okay, the informal definition of an annuity is what I like to say is insurance for living too long. Okay, this is a defined benefit plan under the Internal Revenue Service Code. It's a 401A. So what that means is, you know how you log into, how many of you guys have logged into your TRS website and you see a dollar amount on there? That's what your account is worth. That's your contributions plus whatever the state designates the current interest rate at over all those years you've been working. And that can change legislatively, but it has that number in there. That number honestly really doesn't mean much to you at all, because you'd rather take the payout over time, almost 99.9% of the time. What I'm saying by that is, just a simple example would be, maybe you log into your portal and you see that you have a $150,000 cash balance, right? You obviously have the option to take that out, but you never would. We would never advise you to do that unless something was extremely drastic, because that $150,000, if you leave it in TRS, they're going to start paying you approximately $50,000 a year for the rest of your life till the day that you die. So if you took the 150 out and you took 50,000 out per year, you're going to be out of money in a few years, right? So we leave it in the system. So it's a pension plan. So as people like you guys that are currently working are paying into it, it's also paying out the retirees. And that's how the pension system works in the 401A. So this, again, it's an annuity, okay? But you are the TRS member, right? You that are retiring are the TRS member. You can make this a joint survivor annuity. What that means is you add a beneficiary to the annuity. Okay, you need to add a beneficiary anyway, because TRS does have a death benefit that whenever you do pass, whoever your beneficiary is, it's for $10,000. Or if they're old enough, they can take out $2,500 and they'll pay you $250 a month for the rest of your life. You know, we can give you advice on that. That's completely different from what I'm talking about here. Everybody automatically gets that, and that you can name your beneficiary who you want to receive that. However, if you want your spouse or significant other, or maybe your sister, you can put anybody you'd like on there. If you want them to continue to get funds, to continue to make income, a pension payment from TRS, you'll have to add them as the beneficiary. Okay, so whenever you go and you request that packet, they're going to ask for your beneficiary's information. And when you go online, because it's going to be based upon date of birth and male or female, based upon actuarial numbers on how much that cost is going to be. So in other words, let's say, you know, if you, who usually goes first, by the way, statistically? Is it the man or the male or the female? Usually the male. I don't know why. I've had a lot of good answers over the years, but it's usually the male that does go first. So let's say that you had a 65-year-old individual, but then maybe he married somebody that was 50 years old. You know, you see that sometimes. It's a 15-year difference. Well, all TRS is doing is they're running actuarial numbers to say the average male lives to, say, 83, and the average female lives to be 85. So they're planning on, if something happened to you, that they've got to pay that person out. If they're only 50, they're looking at 30-something years of payments, right? So if that person, let's flip-flop it, though, and say you're the member and you're 50 and your beneficiary is 65, their life expectancy is shorter, correct? So the cost to be able to insure them would be cheaper, all right? So you're going to see the actual dollar figures whenever they come to you. And like I said, we can explain to those in a little bit more detail. But standard annuity is $3,803. Okay, just round it up, make the math easy. That's about $4,000 a month, around $50,000 a year. And that example that I gave you on the $150,000, remember that person, maybe you have cash value of $150,000. If you take out that standard annuity, TRS is going to start paying you the $3,803 per month. Let's say you did it for 5 months, so that's around $20,000. Heaven forbid, you go out to dinner, you get in a car crash, a drunk driver hits you or something like that. You took $20,000 out of the system, but you had how much cash in there? $150. Your beneficiary would get the rest of the money. They'd get the $130. So you're going to get at least what you put in there, okay? However, once you go past that $150, as long as everything stays normal, you're going to keep getting those payments for the rest of your life. But in the standard annuity, once you get past that amount, if you pass away, nobody gets anything. It completely stops if you choose that standard annuity, okay? The second option is option 1. That's going to give them the most. So everybody's different. You know, we have people come into our office for many times where their spouse maybe is set up in a 401k, got plenty of money. They don't need it. Maybe the spouse is ill. They're not having to worry about that cost to give to them. Every single one of us in here is in a different situation. And so they won't choose that. But maybe they have, like myself, my wife is she's been a stay-at-home mother. She's a teacher. She taught for 2 years, and she said she was going to go back about 17 years ago. She still hasn't gone back. So my youngest is 11, so we'll see what happens whenever he graduates. But in this case, you know, if I was the member, she doesn't have any Social Security. She doesn't have anything. So I need to make sure she's taken care of in case something happens to me. So in that option, I would choose option 1, okay? Now, as you can see, the cost there goes from $38.03 to $33.74. You're not actually writing a check for it. It just comes out of your TRS annuity before you get it, okay? And so you'll see what that is on the paperwork when you receive it. And we go to option 2. That's a 50% option. As you can see, it's kind of in the middle of these two. So instead of costing you around $400 a month, it costs you around $200 a month. But what happens is if you, the member, pass away and your beneficiary is still alive, they will continue to get 50% of that dollar amount. So that $35.77, they're going to get around $17.50, $17.60 or so a month, because it's 50% of that option, okay? Now, I'm going to skip 3 and 4. I'm going to come back to them in a second. But if we go down to option 5, that's the 75% one. And as you can see, it's in the middle of 1 and 2 as far as the cost goes. Instead of costing me $400, $200, it's going to cost me around $300 a month in this case. But if I, the member, pass away, then my beneficiary would get 75% of this amount. Does that make sense? On that last option. 3 and 4 is what we normally see when we have folks that maybe never got married or don't have a spouse, or they want to give it to kids, or they want to give it to their sister or something like that. Then they'll choose option 3 or 4. Those are the cheapest ones, because 3 will last for 5 years and 4 lasts for 10 years. But I want to reiterate this, because I've seen it over the years where people choose this option and they get really confused. And and then they chose it, and then they retired, and now they've become a client of ours. 7 years later, they're coming over to me and say, well, I chose option 3, so when I die, my kid or ex-wife or something like that is going to get that amount of money for the next 5 years. That's not how it works. It's from the date of retirement, not from the date of death. So in other words, as you can see, if you chose option 3, right here, that's not that much money. That's only around $20 a month that it costs you. Okay, so it costs you $20 a month. But if you die, say in 3 years, and you chose the 5-year option, your beneficiary will continue to receive payments for 2 more years. But after the 60th month, it stops. The other option, as you can see, is a little bit more expensive. It's about $70 more a month that you're going to get in your pension, but that lasts for 10 years from the date of retirement. Okay? So if, heaven forbid, you retire, you pass away within a year, your spouse continues to get, or whoever your beneficiary is, continue to get that money for the next 9 years. I have seen this over the years. This is probably the most important part of the retirement process on which one you choose. I saw, in this example, it was a teacher. She was the breadwinner. The husband was a maintenance individual. Salary was less, of course, in that position. And then they come to us, and we helped them retire. And they were going back and forth. They were in their 50s out of San Antonio. Well, because she was the one retiring, she wanted to make sure he was taken care of, because his pension was going to be so low. So thank goodness she chose option 1, because it wasn't literally 4 months after retirement, she got diagnosed with cancer, and she died within the next 3 months. Had no signs, nothing at all. But if she would have chose that standard annuities, then he would have got a little bit of money, but then it's just going to stop. So again, extremely important option to look over that. So does everybody understand these or have any questions on these
Jim,
options?
can I jump in and say something really quick? Mm-hmm. So in the 20 years that I've been working with TRS and with employees, I can tell you that I've seen very few people take 3 or 4. So the 1 or few times that I have seen it, it's because they already know they're sick. There isn't a spouse, but they have children they want to leave the money to, but they know I'm passing away in the next 6 months to a year. And so that's about the only time I've seen that 3 and 4 used, is when they already know they're sick. They've got kids that they want to leave it to, multiple. There's no spouse. So it's the only options that they have are the 3 and 4 when they've got multiple kids.
Right.
So just to kind of, throw that out there.
Yeah, thank you, David. That's exactly right. So option 1, 2, and 5, you can only have one beneficiary. You name one person, because it goes from an annuity, an individual annuity, to a joint survivor annuity is what it does, okay? And option 3 and 4, maybe ex-spouse, you have an ex-spouse that's gone, or they passed away and you want to leave it to the kids. If you have multiple kids, option 3 and option 4 are the only options that you could put multiple beneficiaries on. Okay? And like I said, you can go to your portal. We can help you do it, or you can go to it at night in your pajamas and look at it and punch these numbers in here and put your beneficiary age, and it'll show you all of that on there for you. Okay? So now we're going to go to, I kind of just covered this right here. Allows beneficiary to continue payments from TRS upon the death of retiree. Those are the choices that you've got. In all these examples that I'm giving you, let's take another scenario where you chose option one. You want to make sure that your beneficiary is taken care of. That costs $400 a month, or around $5,000 a year. Let's say that you live for 20 years. At $5,000 a year for 20 years comes out to how much money you passed up? $100,000, right? Let's say your spouse was your beneficiary. You guys go out to dinner that night, drunk driver hits you. Who gets that $100,000? Nobody. It stops. You were paying for an insurance along the way. Okay? But let's flip it the other way. Let's say that you're the member, and then all of a sudden your beneficiary passes away before you. Well, what happens in option 1, 2, and 5, they go back up to the original 3803. Okay? Because it goes from being a joint survivor annuity back to an individual annuity. So you're no longer insuring anybody. Okay? So you have that option whenever you do retire to choose one of those. So, all right. Some of you might have heard of the partial lump sum. I would like to start this off with definitely saying the partial lump sum is not for everybody. I mean, you guys have a choice. Clay was talking about grandfathered or not grandfathered. A lot of the grandfathered ones in Tier 1 are pretty much retired by now because you had to meet one of 3 criteria prior to August 31st of 05. August 31st of 05, you had to either meet the rule of 70, so years of age plus service equals 70. You had to have 25 years of service, or you had to be at least 50 years old. And that was 2005. If you meet one of those 3, you're in Tier 1. You have an option to choose the partial lump sum when you hit the rule of 80. Okay? For those of you that are in Tier 2 or later, you've got to go to rule of 90 to be able to get the partial lump sum option. But for some of you guys, it may be a wonderful decision for you, and we've seen people become extremely successful by making that choice, and I'll give you some examples on that. So there are 3 options for taking the partial lump sum. The amount of the largest lump sum option is usually pretty close to what you would be paid into TRS during your career plus accrued interest. The money, we do have people come into our office and say, hey, what's usually the biggest expense you have throughout your life? Would you say? Your home, right? And then how many of your colleagues, or maybe you guys do that at towards the end of your career, you're making double payments on your mortgage, or you're trying to get it paid off because you want that payment gone. A lot of people do that. We see that happen a lot. So people will come and say, hey, this lump sum I'm going to get, I've only got $150,000 cash in TRS. I can take out $140. They'll give you $140,000 if you want. But remember, all that money is taxable, 100% taxable. So it'll go on top of your income that you're currently earning this year, and it's probably going to make your taxes go up, so you're going to pay more on that money. So people will come to me and they'll say, I already made my decision. I'm going to take that $140,000 out, and I'm going to pay off my home. You know what I say to them? I said, well, I get what you're saying, but you just told me that $140,000, that you have $140,000 of that money you can take out. That's not all your money, because who else's is it? The federal government, right? So instead of you getting $140,000, you're probably going to land closer to $110,000, $105,000, because the rest of it would go to Uncle Sam. So generally, you want to roll it over into a tax-deferred account that accepts those types of rollovers. So it's your 403Bs, your 457s, your IRAs, stuff like that. Then once you roll it over, you have the choice to take it out as you want, whenever you want, however you want, whatever you want to do with it. But you put the money in your control. The money from the lump sum belongs to you, and you can do with whatever you want. It becomes part of your estate upon passing. So let's talk about this. As you can see, I added these columns over here with the partial lump sum. So all this is, if you had a calculator, they're going to give you a choice of 12, 24, or 36 months on your lump sum. And all that is you take whatever the standard annuity amount is. In this example, it's 3803. You would multiply that times 12. If you multiply it times 12, that would give you a lump sum of $45,632 that the state would write you a check. Here's the great part about it is, a lot of people say if I take a partial, remember this is a partial, not a lump sum option, but a partial lump sum option. If you take that, they're still going to guarantee you an annuity payment for the rest of your life. So they just reduce it about, so if you do the 12-month one, they usually reduce it by about 10%. The 24 is 20%. It varies between when you start and so on and so forth, but those numbers will be in their packet like we discussed. So in this example, I'm going to use the 24 months. So this is simply 3803 times 24 months is 91,264. So I'm going to get a lump sum, and let's say that I chose the standard annuity at $3,055. So what's going to happen is I get this check for $91,264. We roll it over into our account. And then I'm still going to get a payment of $3,055 a month for the rest of my life. So just because you take the partial lump sum doesn't mean that the payments are going to stop. They're just going to be reduced. Again, this is not for everybody. Maybe if you're somebody that's going to go back to work in a different field, or maybe come back to education, your plan is eventually later, something like that, and you just want to take a little bit of time off, that may be a wonderful thing to do because you can let that money grow over the years and live off of a larger amount later on down the line. And I'll show you an example right here. So in this right here, this person, this is going off the example, what was her name? Hattie Nuff. our example here, our teacher, Hattie Nuff. Remember, Clay showed you this earlier, no lump sum, 100% survivor option. That means I'm going to give my spouse or whoever my beneficiary is the most amount of my money in case something happens to me. Income taxes, health insurance, my take-home pay is $29.04 per month. Okay, that's just a normal retiree. You chose the 100% option for your survivor. On this one, you took the lump sum. You chose the 100% survivor again. But what's going to happen is I go down from $33.74 to $27.13. And as you can, we're just using a flat tax rate is what we're using because it's really a marginal tax rate of what it is. Your health insurance coming out, your net take-home pay is now $22.96. Okay, so if we look at that, you got the partial lump sum of $91,264. If you had $90,000 in an account earning 5% per year, that would give you $380 per month in interest without you even touching the $91,000. Okay, now some people over the years, they say, wait a second, where are you getting 5%? You know, what's going on with this? You know what's been going on in the news. All of us do lately, the past couple of years. What have interest rates done? They've gone crazy. We just had a client buy a CD, a 2-year CD at 5%. I am very confident that over time we can achieve a 5% rate of return. As a matter of fact, over any 20-year period of time, over the past 50 years, the worst you've ever done is around 6.5%. Okay, so 5%, I feel very comfortable with that. So what we try to show people is maybe think about passive income. Does anybody own rental properties in here and they rent them out? Got one right here. So you have active income and you have passive income. Active income you guys made today, right? You went to work. You're getting paid for that job that you did. Okay, you're earning money. And then you also have the passive income, which means let's say you owned 3 rental houses that were paid off and you had renters in all of them paying you. That's passive income because you already did something to get it and they're just taking it. But it's hard to create passive income. But when we can do that, it can be very powerful. And that's what this $91,000 will do. It will create passive income and it can generate interest for you, and then you'll be able to live off of. So now let's look at this scenario. Let's say you took the lump sum and you said, you know what, I just want to take out 5% per year. And then right here, your income from that is $380. Of course, you got to pay taxes on it. But your net take-home pay is $26.46. So that's only a difference of around $250 per month. But you get $91,000 that goes into your own name. And remember all those other options that I showed you? Option standard annuity, option 1 through 5. How many beneficiaries are you usually going to choose on that? How many can you choose except for the 3 and 4 ones? You can only choose one person. Okay, with this, you can choose whoever you want. You can give it to your spouse, you can give it to your sister, you can give it to your church, you can give it to your dog, whatever you want to do. You literally can put anybody. So that gives you an option for some people that don't really have a beneficiary that needs a monthly income, but they want to have some of their money in case something happens to them. Then you can utilize that to do that. It helps you do that. So is the partial lump sum for you? Remember, your TRS check will be reduced by about 10 or 20 or 30%, but you're still going to get a guaranteed payment for the rest of your life. Do you have other money saved for your retirement years? Maybe you have a 403B or an IRA or a 401k from a previous job or something like that. It's very wise to take the partial lump sum, let it grow, and live off that for a little bit. Live off that for a few years, and everybody know what the rule of 72 is? We've talked about it before in our previous presentations. We always talk about it at the campus level. If there's one thing that I could take that you could take home tonight financially, just a little tidbit of knowledge is, everybody remember the rule of 72. It's a simple equation, and all you've got to do is take 72 and divide it by the interest rate that you're making, and it'll tell you how many years it takes your money to double. It's that simple. So if you had $10,000 in a savings account earning 1%, 72 divided by 1 is what? 72. It would take $10,000 72 years to be worth $20,000. Okay? So if we were just able to do 6%, 72 divided by 6 is 12 years. That means your $10,000 would be worth $20,000 in 12 years. So that's how important it is between 1 and 6%. So if you have other money saved that you can live off of, and you just let that lump sum sit, just on a 7% rate of return, that if you have a $100,000 lump sum in 10 years, how much is it worth? $200,000. That's what it grew to without you taking anything out of it. That's a wonderful position to be in for those of you that are saved for your retirement years. And we talked about that a second ago. Do you want to leave money to your family when you are gone? Remember, TRS ends with you and your spouse or whoever your beneficiary may be. And will having a nest egg be important to you down the road? Do you think you might need to access large sums of money at some point over the rest of your life? Or do you have some bills you'd like to pay off? In that example, we see a lot of folks that come in too and they say, I got one more year I'm going to go. And I go, okay, that sounds good. Let's plan for one more year. Let's look at this year. Let's look at next year. Let's look at 2 years out. We can look at whatever you want to do. And I'll say, why are you going one more year? And they say, well, I got to pay. Usually it's because I got to pay some student loan off or a home or something like that are almost to the end of it that they did for their kids or their grandkids, or sometimes even themselves, they're still paying on it. But what they do is on that lump sum, remember that example, the lump sum was $91,000? Maybe they need $10,000 or $15,000. You can actually take $10,000 or $15,000 and take it as cash and roll the rest of it over. So you can take that, wipe that debt out, and now that $1,000 a month payment or whatever you had on your debt is gone. Okay, so that's another option that you do have in there with that. So let me cover just one more thing in this. This, especially for people that are going to pursue a different career. If you're going to pursue a different career or do something even part-time, remember, because if you took that lump sum, you're only looking at about $250 a month that you're going to have less. How much subbing do you have to do to make up for $250 a month? Not much. You can greet people at Walmart. You can do whatever you want to do, but you put that money in your control. So in that case, it's almost always the best scenario for you to do if you're going to go back to work and earn another income, okay? So let's talk. Debbie's going to touch on this a little bit more on the CCISD sick leave payout. I'm about to wrap it up, and then Debbie will come up here and talk to you guys about the HR part of it. But the district buys your sick leave from you when you retire, both state and local days. And Debbie, interrupt me if I'm wrong on this. They pay half your daily rate for local sick days. Restrictions apply, which she'll discuss. So for a teacher making $63,000 when they retire, that would be around $168 for every 8 hours of accumulated local leave. $120 for every 8 hours of accumulated state leave for certified employees. Okay? I see a lot of you guys, you're taking notes, take pictures. This is all compliant approved. Like they said, they got it on the live stream. Take as many pictures as you like. And then so you can go over this information because I know it's a lot. $60 per day for non-certified employees for state days. Restrictions apply. The sick leave payout will come after you have received your last work check from the district. Your first TRS check shows up shortly after that. Some of you guys, we've seen people that just don't miss work. You've been teaching or whatever your position may be for 35 years. And then you've got all this sick leave built up. We've seen them for $20,000, $30,000. Remember, if you take that in a paycheck, the computer sees as you making that per month. So how much taxes they're going to hold out a lot of taxes. You're not going to get that full amount. The district will allow you to roll that, or to make a contribution to your 403B or 457 to be able to take the taxes off of that. Okay, so you don't have to pay that. You can pay taxes on it as you take it out later on. And so to talk about that, like I said, Debbie's going to come up here in just a bit. So what should I do next? Contact TRS and order a packet. If you haven't done so, do ASAP. Go online. Like I said, you can print out the form. There's several ways you can do it. We've been submitting all of our customers and clients that come in. TRS now accepts faxes. They started to do during COVID. It had to be hard copy everything, okay? The paperwork may seem a little bit intimidating because the packet's about that thick, but how many forms do you actually have to fill out? 4. That's it. So it's a lot of information. Like I said, a lot of the information they're going to give is going to be general in nature, and it won't be for specific advice. But I would do that as soon as possible. And then if this is your year, you should really plan on submitting the forms to TRS by April. However, you can still decide in May or June. The last date that you have to decide, as far as the state's concerned, of course, the school district would like you to, and she's going to talk about that benefit too that probably a lot of you guys are having in your mind right now, that the last day you're able to retire and go back is 60 days. So you can go 60 days past and you can claim your retirement date that, and they'll still give you checks for that. But with that being said, I appreciate you guys' time. Debbie, are you ready to come on up?
I'm here, ready to go.
Does anybody have any questions for me at all? Okay. Well, like I said, Clay and I will stick around here. If you guys have questions that are maybe private in nature, you want to talk to us about, we're more than happy to help you guys. Thank you for your time. Appreciate it.
So TRS is taking up to 90 days to get a packet back to you. At least that's what they verbally tell you. And so you don't have to print the form. I already have a bunch out on the table. So if you didn't already grab one, this is the form that you need to fill out in order to request your packet. Now, you can fax the form to them, and if you've got a pen, I'm going to give you their fax number right now. The fax number is 512-542-6597. So the 2 quickest ways to order that packet is going to be fill this form out, and when you get to work tomorrow, fax it to them. Fill it out before you leave them with me, and I will fax them for you. Those packets do not come to me, to CCISD, or to your campus. These packets go directly to you. Now, just because you order a packet doesn't mean that you're on the hook to retire. Nobody needs to know that you ordered a packet. Keep in mind that it could take up to 90 days. I did have somebody get it less than 60. I was a little surprised, but I don't know if now that they're kind of sort of back in the office, they're kind of trying to get back to things quicker, but nonetheless, 60 to 90 days. So you want to fax this to them. If you have your password, your user ID, you can actually request this packet online. So it's something that you can do on your own on the computer. You can check back with the guys from Elite, and they can help you do this online. So you can do it online, or you can fax the form, or you can leave the form with me today, and I will fax it. I always encourage, even if you're not sure, fill it out. Just at least take a look at where your numbers are at. The other thing is that you can put multiple dates. So if you haven't truly decided, do I want to retire now or next year or 2 years from now, you can put this year versus next year. You can put next year versus 2 years down the line. Not everybody in this room is at their rule of 80, okay? And I get that. And so some of you are thinking, I've got 2 more years to go, 4 more years to go, so I'm just kind of wanting to see where my numbers are at. This is a great way to start, okay, and just getting your information. So for some of you that have already looked around, this is not an opportunity to start rumors tomorrow. Guess who I saw? For those of y'all that are watching, if you can see the backs of heads, I promise you don't know who they are. This is informational only, okay? I know that a lot of you signed in. That's just so that we can show our supervisors and their supervisors that what we're doing is important and that our employees want to learn more about retirement. We were not going to let anybody know that you were here. And again, just because you filled out a packet doesn't mean you have to retire. You can order a packet every single year until you get to that point. So this is the form that you're going to use in order to order that packet. Now, when do you need to submit a letter of retirement, and does it need to be a formal letter? So if you want a formal letter, you can always email me and I can send you the Word document, but I did put one out there, and there's 2-sided. So when you retire from the district, you have to let us know how you want your payout. So when I say how you want to get paid out, a lot of you, most of you are probably on campus, and so you only work your 187 days. For most of you, your retirement date is May 31st. You are still going to work a couple of days into June, but the retirement date itself is May 31st. What you need to know is that if you do not specify to the district how you would like to get paid June and July, we will automatically cut you off May 31st. That means that your insurances end May 31st, and the money that the district owes you for June and July will be paid up front to you on your May 31st paycheck. If you would like to continue your checks like you normally have them through the summertime, if you want to continue your benefits through June and July, you have to specify on the form, and we do have one on the website, it's an intent to retire form, or make sure that our notice, the letter that you submit to the district says, I would like to continue my paychecks and my benefits through July 31st. This way you can continue your checks, continue your benefits. So I've given you 2 samples. If you're gonna cut out of here on May 31st, there's a sample of what your letter should look like. You can personalize it. You can say how great you loved the district, or you can just say, you know what, I'm just done. I'm ready to hang with my grandkids. I'm ready to vacation, move to Greece, whatever it is. You can do it word for word. You can adjust it, but I have 2. If you're gonna retire May 31st, but you wanna continue your benefits through July 31st, there's your sample letter. So you can do a letter, personalize it. There is an intent to retire form that's available on the Human Resources website that you can go to, and you can fill that form out and just fill in the information and submit it. Now, when do you need to submit that information? If you are a para or an auxiliary employee, food service, custodian, bus driver, you have to give the district a 14-day notice. And that's it. You let us know 2 weeks in advance. Why do we have that stipulation and requirement? Is because a lot of you probably still have unused local and state days. You've accumulated time over the years with the district, and that money is payable back to you at a certain rate, okay? And it's based on your years of service. So I can tell you that if you've been with CCISD, not in TRS, but CCISD, for greater than 15 years, then the district is going to purchase your local days at half of your rate of pay. If your rate of pay is $300, then we're gonna buy those days back to you at $150 a day. And then we're also going to purchase your state time. But in order to be eligible to receive that payout, if you are an auxiliary employee or a non-certified employee, you have to give the district a 14-day notice from your last working day. If you are a certified contracted employee, you have to give the district a 30-day notice. So what happens if retirement is May 31st, your last working day is June 2nd, you wanna let us know by May 1st that you're gonna be leaving us June 2nd and gonna be retiring. If you let us know, let's say May 15th, and you're a teacher, you're no longer eligible for a payout of all of those days. So it's important to understand what my position is with the district, and am I a 14-day notice or am I a 30-day notice employee? But if you have unused days and you've been with the district for 5 years or greater, there's different formulas that payroll uses to figure out how they're going to or what they're going to pay you. But you want to make sure that you're eligible, and you're going to be eligible by submitting that notice of retirement 30 days in advance or 14 days in advance. If you are a teacher or an educator, we do not typically allow employees to leave in the middle of a school year. But in the event that that is you and you're needing to retire at the middle of the year, give your notice as soon as you've made that decision. Because it's in the middle of a year, we don't want to affect the instructional time to our students. And so they can't release you from your contract until we have another person certified, another teacher in your place. So if you're just leaving the district at the end of the year, you've put in your time, then congratulations, and I'm jealous because I'm not there yet, and go and enjoy retirement. You have done a service to the district, and we appreciate you for it, and we thank you for it. At this point in time in your career, it is important to do what is best for you, and only you know what that is. So just keep in mind when you're submitting the letter, 14-day notice or 30-day notice. When you submit your letter, make sure that you specify, I would like to continue my checks through July 31st. If you just want to keep a payout at May 31st, you can specify that in your letter, or you can just not say anything, and we are going to cut you out on May 31st. Now, when you submit your packet to TRS, they're only going to send you information on retirement. They're not going to include any medical information in your packet. Once you've submitted your documents of retirement to TRS, that should trigger in their system for them to mail you the application to then take TRS care and have health care with TRS. If you are submitting your documents kind of a little bit late, they have to have it by the 31st in order to give you benefits the first of the month. They do not issue medical insurance in the middle of a month, in any given month. So if you're kind of running close to your deadline, I always tell employees, call TRS and say, I've already submitted my notice. I haven't received my application, but you can set it up in a way to where your district benefits end on the 31st of it, whatever month you're going to retire, and on the 1st of the following month, you would have your health insurance with TRS Care. So there's a way to plan it that you do not have a gap in coverage. So if you have any questions about that, you can always reach out to Elite Plus. You can always reach out to Employee Benefits. You can email us, and that email address is insurance@ccisd.us. You can call our office at 361-695-7210, and we'll be happy to answer any retirement questions you have. But the most important thing is to know, order your packet, order it as soon as you can. And even if you're not going to retire, it's okay. At least you've got some numbers in front of you. The other thing I will tell you is that, I don't know if y'all knew this, but I don't like it. TRS has now changed their tax form. And they're now using the actual IRS form. And so you've really got to know your deductions and who you're going to be accounting for as far as your taxes go. So the tax portion's a little bit different. So we kind of have to be a little bit more knowledgeable about it. But we'll work with you. The guys will work with you. If you have any questions, they will be here. Like Christy said, we are going to be the last ones to leave. They do have cards out on the table, so if you want additional information, please feel free to fill it out. The forms, the samples are on that table. We've got some goodies. Grab on your way out. And if you have any questions, please feel free to ask now or ask later. Anybody?
I have a question.
Okay, go ahead.
You did say that about the notice of eligibility. Now, you said that the district really doesn't like it, but if you do leave mid-year, because I've heard that if you work through the end of the year, it counts as a full year.
That is true. So for CCISD and TRS, those are two different things. So where CCISD prefers that you don't leave in the middle of the year, that's only for our teachers because of instruction to the students. However, if you know you need to leave for whatever reason, you can submit your letter of retirement to the Department of Human Resources. And the sooner you get it to them, the sooner that they can find a replacement. So if you know in August that you're going to retire in December, submit it in August. That gives them plenty of time to find someone to fill your spot so that when December 31st comes around, you're free to go and they can release you from your contract. Now for everybody else, why is she asking about December? For TRS purposes, as long as you finish the first semester, they will give you an extra year of service credit. And an extra year of service credit means a little bit more money in your paycheck. So typically it's, however many years you have with the district. So if I have 25 years with CCISD and I know my semester is ending December 31st, I may decide I'm going to work till December 31st so that I get 26 years. 26 years will give me a little bit more money. So every year you stay with TRS, the money that you're going to receive, the amount, the dollar increases every single year. So if you know that you are that teacher and you want to leave in December, the sooner you let Human Resources know, the sooner they can fill your spot. For some years, it is December 31st. For some years, it's been January. It just depends on when the semester ends. So it is December 31st for this year.
Finish the first
Semester, the
And
first
then
90 days.
Does that affect the pay, your sick leave pay that you have?
As long as you give the district the 30-day notice, you will get paid that time. There is a maximum. So for most of you, I would believe that you're still grandfathered. They will not pay more than 200 of your local days. I've had my first employee that had 227 days. In my 16 years with CCISD, I've never had anybody hit the max. I met my first one last week. So she's got 227 days. The most we can pay her are 200 local days. So from now until she retires, she's got 27 days that she's got to take, a day here, a day there. However, the district only allows 5 state days per semester. So just keep in mind, if you're over the 200 days, the max that CCISD will pay is 200, and on your state days, it's 125. Someone over here had a question. Yes, ma'am.
There's a form that came from the TRS and it says about our final payment from the district.
A TRS 7. So what's going to happen is when you grab your packet from TRS, there's 4 forms. You're going to submit a form that tells TRS, this is what I want, this is who my beneficiary is. You have to send them a bank form. They need to know where you want your money deposited. You have to fill out a tax form. That tax form is going to let them know what your deductions are supposed to be. You have to send them proof of age, so your driver's license, a birth certificate, or passport. There's one more notice, and it's the notice of final deposit. That comes to CCISD. That form is not filled out by the employee at all. Our payroll office will fill out that form for you, and they cannot fill it out until your last check with the district has been processed. So once you're done meeting with Elite Plus or in my office, we always tell you, we're done. Go on your merry way. There's nothing more you need to do. And then you get a surprising letter that says, okay, we've received form. However, we cannot process your retirement because you have not submitted TRS-7. It's nothing that you have to do. You are really, truly done on your end. It's a form that CCISD payroll has to fill out, and they will fill it out once your last check has been processed. Any other questions? Okay, either we did great, or they want to come and talk to us afterwards. So thank you for joining us online. For those of you that want to hear a repeat of everything, it will be available on the YouTube channel for CCISD under communications, so feel free to watch it again. Email us with your questions, fill out a card, and make sure to get it to the guys if you'd like to visit with them. And we will stick around and answer any questions you might have. Thank you. I didn't share this, but I will say this. For those of you that are teachers, the superintendent has usually offered a $1,000 incentive. They have not made a decision on whether or not they're going to make that available. So pay attention to your emails. And if they do offer it this year, you will get an email directly from the superintendent.